Mark, let me just start with those numbers. You know, we were looking for a decline of 303,000, or at least economists were, in job openings. We ended up with 441,000 additional job openings. What does that say to you about the health of the U.S. economy and or your view of a potential recession?
Well, David, it shows that the job market is very resilient. It's hanging in there very, very strongly, despite all the things that are going on around it. But, you know, I don't know that I'd read too much in the month-to-month, particularly in the job opening labor turnover survey. It goes up and down and all around. And I think the trends here are pretty clear. Businesses are pulling back on their unfilled positions. And we'll obviously get a much better read on things on Friday when we get the numbers for the month of October. The other thing in the report that I think is probably even more important, but we don't pay as much attention to, is the number of people that are quitting their jobs. And that did come in a little bit. It's about 4 million. Still very elevated, still very high. That has to come in more. But that's the key to wage growth. And wage growth, obviously, is what needs to moderate to get inflation back in. So, you know, it's not exactly what I would have, if I were writing it on a piece of paper, I'd like to see. And I guess that's what investors are saying to us right now. But, I wouldn't read too much into it.
Now, what if you were writing it on a piece of paper would you like to see?
Well, I want to see those unfilled positions come back in. So we're at 10.5, I think in the month of September, 10.7 million. You know, before the pandemic, which is a pretty tight labor market, we were at, 8.5 million, something like that. So that's the next step on the piece of paper. And I'd like to see it come in a little bit more, even more than that. It'd be, really ideal if the unfilled positions evaporate, unemployment rises just a little bit. We're at 3.5, maybe it goes up to 4. That'll take some steam out of the labor market, get wage growth down. And, on wage growth, we got some pretty good news last week. The employment cost index came, says wage growth is about 5%. A good benchmark, if I had a piece of paper, is we needed to get down to about 3.5%. So we're headed in that direction. I'd just like to get there a little bit faster.
Yeah, openings rose, hires came down a bit, and also, Mark, we didn't pay as much attention to the ISM, but prices paid 46.6. What happens if we wind up in a situation where we actually have very clear and convincing goods deflation, but labor just doesn't cooperate?
Well, we need the goods deflation. That's step one in getting inflation back headed south towards the Fed's target. And I think check, that's happening. The last thing that we need to see there is on that side is new vehicle prices starting to come in. That might take a few more months, but that'll happen. But we do need the labor market to soften here, and we need to get wage growth down. If that does not happen, if the Fed follows through on its script, 75 basis points tomorrow, 50 basis points December, a quarter point in January, stops, takes a look around, and the labor market isn't weakening and wage growth isn't rolling over, then I think at that point they'll step on the brakes some more, and at that point we'll go into recession. I still think, Carl, we have a chance here that, they'll stick to that script, get us into next spring, take a look around, and the labor market will be easing enough, wage growth rolling over sufficiently that they can pause, and that can be the end of the rate hikes. And if that's the case, then I think we have a path forward to an economy without a recession. Weak, no matter what, it's going to be a pretty tough year, but we can avoid a recession.